EBI on a very interesting and I would say topical issue titled EU Environmental Reporting. Is it an effective tool to deal with greenwashing? This panel comprises 4 experts in the field, and we are grateful that they accepted to participate, and some of them are closely linked to the EBI, like Maria and Agnieszka. We very much hope that this will be an opportunity for Gábor and Chryssa to come closer to us, at the EBI, and have you again and again in one or more of our events and our other activities. I will briefly introduce the panel, and you will see that apart from their presentations, their actual and former work is very much related, if not say in some cases confined, to the field which we are dealing with. Maria Nieto is a senior advisor at the Banco de España. She is contributing to the work of the network for the greening for the financial system. One of the most important groupings for the last 10 years in the field of sustainable finance, at least. And she's also linked to the work of the EBI. She's a member of our associated researchers group, like Agnieszka as well. Gábor, I follow the order now. Chryssa, I would say, is a very good friend of mine from for a long time now, and she's currently, I will also mention your official title, is a professor at the International Hellenic University, but she's also very much involved in policy making in the field. The same applies to Gábor. Gábor is a consultant, an expert consultant supporting the UNEP FI. We all know the United Nations Environment Programme's Finance Initiative. And he's also the founder of the Hungarian Sustainable Investment Forum. And last, but definitely not least, another person I know for so many years, Agnieszka, a former student of mine, quasi-student at the EUI in Florence when you were writing your thesis. She's currently a very active member of our advanced researchers group at the EBI, and most importantly, also a senior policy advisor at the Center for Economic Transition Expertise, the CETEX, at the LSE. Without further discussions, I give the floor to Maria to introduce the topic and open the floor. Thank you very much, Maria. I must say that you have been the driver behind this event, and thank you so much for this, and thank you all for having accepted to participate. Maria, the floor is yours. Thank you.
Thank you, Christos. Ricarda, maybe we can start sharing the presentation. Well, thank you, Christos, again for chairing this session. Thank you to the European Banking Institute for supporting it, and good morning, everyone. The way I plan to present is the following. I would develop all my presentation around 3 points. What is greenwashing and why it is important? The macro dimension of greenwashing, so the economic consequences of greenwashing for the European Union orderly transition envisaged in the European Union climate law, and the microeconomic dimension, the implications for the firm. And I will use the abundant literature to discuss this point. Ricarda, next. What is greenwashing? Well, greenwashing is also known as climate washing, and the need to combat greenwashing came under the spotlight at the United Nations Summit of the Conference of the Parties 26 in Glasgow. As many of you probably know, there is no an internationally agreed legal definition of greenwashing, and this, of course, reduces legal certainty. However, in the European Union, there is a common understanding among the European supervisory authorities, a practice where sustainability-related statements, declarations, actions, or communications do not clearly and fairly reflect the underlying sustainability profile of an entity, a financial product, or financial services. This definition is broad because it includes entities, services, and products, and is agnostic to whether it's a willful misconduct or not. Next. Now, why is important and why greenwashing is a concern? Well, first of all, because it's a risk that has grown significantly in the past years. And as reported this year by the European Banking Authority, there has been an increase of 26% only in 23 of alleged cases in the European Union. Interestingly enough, the financial sector is one of the most affected. By the way, this development is the same in the United States, and it's even more than companies in the sector of oil and gas, for example. This raises the question whether greenwashing is the result of unintended behavior. And this unintended behavior could be the result of, first, methodological issues. Greenwashing is a very different risk from the typical risk that we are used to deal as regulators or supervisors or even central bankers, because it's a forward-looking risk. It's a risk that will materialize over time, and in which the past is not a good predictor of the future. Moreover, it's plagued of uncertainty. This is why we use scenarios, that they are expressed in terms of probabilities. Also, there has been a rapid regulatory development. There was a flurry of regulation in the aftermath of the Commission 2018 Action Plan and the update in 2021, which coexisted with insufficient progress on the regulation of due diligence and third-party verifiers. This flurry of regulation was aimed at reorienting capital flows towards sustainable investments. And the consequence of all the 2 points above, it has been the lack of knowledge and experience in the market participants. Next. There are two dimensions that are relevant on greenwashing. One is the macroeconomic dimension, and the other one is the microeconomic dimension. As per the macroeconomic dimension, greenwashing stands as an obstacle to the collective endeavor of the net zero emissions, and this would have consequences and implications for the EU economy at large. As per the microeconomic dimension, these are implications for the firm. Litigation and reputational risk are associated to greenwashing, and this in turn has two facets: the facets of consumer protection and business conduct, which is the responsibility of market supervisors, and the safety and soundness and prudential regulation, that is the responsibility of the prudential regulators. Next. Let me start now with the macroeconomic dimension, and this figure represents the sheer size of investments, public and private, that are going to be necessary for the purpose of mitigation only during this decade, 2020, 2030. These are estimates by the European Commission and also the European Investment Bank and the International Energy Agency. These estimates are in certain range. They don't coincide because they use different assumptions and different models. But just to give you an idea, when we talk about investments in renewables, so this is just the substitution of fossil fuels by clean energies, we are talking about, according to the European Commission, of an average of close to 70 billion per year only during this decade, and almost twice this amount as estimated by the International Energy Agency. Now, if we include other investments, like, for example, investments that are not related to transport, but had to do with the transition, like power grids, boilers, new fuel production and distribution, green hydrogen, and energy efficiency measures, the average amount is close to 470 billion per year. Now, if we include transport, and this is not only the electrification of road transport that is well known, but also the investments in the decarbonization of the transport of goods by air or maritime, the sheer amount is as large as 1,170 billion, close to it per year. So these investments will need to be covered both by public funds and private funds. What I want to bring to your attention is that the source of public funds that come from taxes, which is a pivot in the European strategy as per the Fit for 55 package of regulation, is effective as a policy lever to discourage the use of fossil fuels, but not as a source of funding for these investments, in the sense that, first of all, the amounts are limited. Although other sources of public funding do exist in the European Union, we have to recognize that also the fiscal position of the different countries in the European Union is quite different. But again, coming back to the taxes, this source is limited almost by definition. First of all, because if we are successful in the process of decarbonization, by definition, the amount of income that we will get from this source will be limited. So that means that the gap will have to be financed mostly by private resources. Next. Okay, now let's turn to my next point, is the microeconomic dimension, the implications of greenwashing for the firm. And on this, there is ample literature, mostly financial literature, but give us the economic rationale of in what direction regulation should go. So there are three streams of literature in this regard. What are the economic consequences of greenwashing? What are the relevant regulatory components of the sustainable finance framework? And the relevant elements of the regulatory design. So this is the content of corporate sustainability disclosure. What are the economic consequences of greenwashing? In this, there is definitely a consensus in the literature that market penalizes greenwashing behavior by lowering the reusance probability and making it costlier for greenwashing firms to reissue. There are also reputational risks from lawsuits associated to greenwashing, and this results in larger market premiums. As per what are the relevant regulatory components of the sustainable finance framework, that's the second stream of literature. Here also there is consensus. There are three elements in which all the literature coincides. There is a need for a common definition of what is environmentally sustainable. Hence, there is a need of a taxonomy. Ideally, that is supported by research and science-based. Okay. The second element in which there is consensus is the need to ensure a high level of transparency and credible third-party verification. Chryssa, after me, will develop on these 2 points. And the third element in which there is consensus also in the literature is the need to harmonize criteria and labels for certain sustainable investments. And Gábor will talk about this. The third stream of literature has to do with the relevant elements of the regulatory design, the content of the corporate sustainability disclosure. And here, as with regulators, we are going to find ourselves with a new regulatory tool, which are the transition plans, and Agnieszka will talk about this. And third-party verifiers are a mechanism to reduce info asymmetries, and also this becomes as an important element in the regulatory design. I'm concluding, I see you, Christos, there, by saying, as I mentioned when I share information about the seminar today, that greenwashing is an action against transparency, but also a threat to sustainability as a public good, putting at risk the EU climate objectives. Thank you.
Thank you very much, Maria, for this introduction. You have set the scene for the following presentations. And I give now the floor to Chryssa. And I need to say that due to another prior commitment, Chryssa will have, unfortunately for us, to leave immediately after her presentation because she has to join another meeting. Chryssa, thank you very much for being with us, and please go on.
Thank you very much, Professor Gortsos and Maria. So as Maria introduced before, we are going now to talk about the taxonomy and the definition of what is sustainable in Europe. And the cornerstone is, of course, the taxonomy regulation, where we have the definition of what is a green investment, what are sustainable activities, 6 big topics. And this enables, of course, to have a common language about environmental sustainability and designs a market transparency tool. The key provision of the taxonomy is Article 8, which requires corporates to disclose the proportion of capital expenditure and operating expenditure related to sustainable activities, with reference also in transition plans, as Agnieszka will develop later. But just to have the definition of what is sustainable activity does not help. We need also to ascertain that the funds are channeled through these activities. And the way to do it, as Maria has already introduced, is disclosure. And I'm going to cover now the Corporate Sustainability Reporting Directive, which is linked, of course, to the taxonomy, obviously, to the definition of what is sustainable in Europe, and also introduces the double materiality. So companies are obliged to disclose not only how the environmental changes, climate change and so on, or other risks impact their operations, but also how their operations impact the environment. So here, Maria and I argued in a previous paper that the sustainability has become a European public good, and we find evidence in this Corporate Sustainability Reporting Directive. And here we know that corporates need to publicly disclose the implementing actions in line with the European climate law, and also they need to have a separate reporting in the management report, also on sustainability, and also in consolidated financial statements and reports. The breaches are sanctioned under national law. Here we have an uneven playing field, but then this part has been further harmonized in another important legal act, which I'm going to develop now, the Corporate Sustainability Due Diligence Directive, which was adopted this year. The Corporate Sustainability Reporting and the Corporate Sustainability Due Diligence Directive have different scope, so they apply to different entities. The CSRD applies to large and listed, so SMEs, smaller and medium, but are listed. The CSDD has a narrower scope, applies only to large corporations, and it covers the activities both upstream and downstream. Apart from financial institutions, where the obligation to conduct this due diligence for contractors is only limited to upstream value chain, so the company and its affiliates. It introduces obligations of means, which means it's on a best effort basis of the corporates to mitigate the company's environmental impact. And again, they need to report in their annual transition plans. And here we have also the notion and the term, the concept of third-party verifiers. Why? Because we want these disclosures to be comparable across the board for all companies. 2 innovative features in this directive: the harmonized administrative penalties, which are quite high for breaches of the Corporate Sustainability Due Diligence Directive, that the member states need to introduce But here we're not anymore in these high-level principles of dissuasion and proportionality. We have really very concrete and high administrative penalties that can be up to 5% of the corporate net worldwide turnover. And another novelty is a reference to the civil compensation. So tort claims, basic non-contractual compensation under national law, which is explicitly referenced in this directive, for intentional or negligent breaches of the key provisions of this directive. So you see that these two directives have given some teeth to the corporate disclosure. Our recommendations from so far has been that we need to finish with to complete the development of the EU taxonomy. There will be a requirement for better coordination among the authorities that are competent for the implementation of these two directives. Ideally, the scope of these two directives should overlap, and also for the transition plans, in order to be comparable, they need to be science-based. So ideally, there should be one scenario provider, like the International Energy Agency, to be used so that we have a better comparability across the disclosures. And then finally, any future regulation of greenwashing should utilize the existing corporate sustainability disclosure framework. Thank you very much for your attention. And with that, I give the floor back to Christos.
Thank you very much, dear Chryssa. That was brief but very concise. I will now give the floor to Gábor. Yeah, thank you, Gábor.
Yes, good morning, everybody. I'm also really pleased to be here. I just want to have one slide, but let me then open that one. Can you see it now in full screen mode? Okay, hopefully, yes. So basically, I will just...
yes, we can see it, yeah.
Thanks for confirming. So I will just basically a little bit pick up the thread where Chryssa finished. So basically, what happens with all those corporate sustainability reports, data points. So I'm just taking a look at the sustainable investment landscape and more using this value chain, which is also now used by for instance, ESMA and other regulators. There are certainly some dilemmas in the retail sustainable investment space, but also I think there are a lot of let's say things that we can celebrate because I think we have made a lot of progress. I'll just basically flesh out some points here, more like questions and dilemmas, starting with sustainability preferences. I think MiFID and also the Insurance Distribution Directive really introduced a very major, very strong point that basically this is now an obligation that the sustainability preferences need to be asked about from the client. But well, we all know that basically the suitability assessments don't work perfectly yet. This is more like a more general and broader problem than just the sustainability preference part. But here I think, have to recognize that there is still a lot to do, but actually now regulation has really introduced a very powerful mean there. If the assessment of sustainability preferences is not done correctly, I wouldn't call it greenwashing, but that also certainly not helps us to fight greenwashing. Then my next point would be, let's a little bit mention ESG rating providers, the misconceptions about ESG ratings and the reliance on ESG data providers. Actually, of course, we all know that this industry also goes through now an evolution. ESG rating agencies are coming under regulation. Also, actually, the emergence of CSRD and the upcoming European Single Access Point also creates a completely new landscape for ESG rating agencies. But at the moment, they are absolutely very important in many countries and then also for many investment fund managers. They are relying a lot on these players. However, we shouldn't forget that basically fighting greenwashing and identifying greenwashing is not really the role of ESG rating agencies. And again, a lot depends on how they are doing their job. They are super influential, just as we saw it with credit rating agencies. But again, they won't be there to spot any greenwashing issues. This is not really their job to do. Then let me maybe talk in a combined way about the so-called principal adverse impacts and the do no significant harm criteria and the so-called social medium safeguards. Again, we've already touched upon previously with the taxonomy regulation, but also SFDR uses these terms. These are absolutely very important if you want, and actually if investors want to judge the sustainability characteristics of products. Here, I think we should really celebrate that without saying that things are perfect. There is a very good alignment between the new European sustainability rating standards, data points, and basically what is required by SFDR. So for instance, basically all the principal adverse impact or so-called PAI indicators, you can find them in the ESRS standards, both the environmental and also the social ones. Here, I think the big challenge is that many of these data points are subject to the double materiality test. So we cannot take it for granted that these data points will actually be reported by the firms under the scope of CSRD. But let's hope that basically these double materiality tests are really done properly, because these are material for the investors in many cases. So that's again, I think, one very strong link between the SFDR and CSRD/ESRS regulations. Then shareholder engagements, again, in SFDR, that's also a very novel and I think very important element, that we are not just talking about products with certain sustainability characteristics, but also basically asset managers and investors need to report whether they are doing as shareholders of companies engagement. Are they really engaging companies? They need to report about that. They might inflate those reports. They might accurately report about their activities. So that's an often overlooked element where actually greenwashing can take place, but also it's potentially very powerful. For instance, when companies are pushed by investors to be even more transparent. So actually, shareholder engagement could also be a force for tackling greenwashing. The net zero strategies, we've mentioned them, and Agnieszka will talk a lot about transition plans. I just wanted to mention that also SFDR also brings this in. There are products tracking Paris aligned benchmarks. There are products with decarbonization pathway. I think that's great. But of course, we all know that net zero is a very complex topic, and maybe I'll just leave it there in the interest of time and rather turn to the definition of sustainability, sustainable investments. In the SFDR, this can be taxonomy aligned, but investment fund management can use other definitions, which is good because SFDR is inclusive. However, basically everything which is not taxonomy defined, that's obviously, we know that brings us to uncertain territory. So greenwashing can actually very much happen with investments which are classified as sustainable investments, but which are not taxonomy aligned. So again, it's a double-edged sword, if I can put it that way. And I think we all know that now the so-called and very famous or infamous Article 8 and Article 9 classification of funds are used like as labels, even though they are not really designed as labels. So the upcoming SFDR revision will hopefully also address that element of the regulation. And finally, maybe I just want to mention that, of course, these investment funds and investment products can make a commitment about, for instance, how much sustainable investments they would do, how much taxonomy aligned investments they would do, and then they need to report about those commitments in their annual report. So I think this is now, I think, a very well designed piece of regulation, and already now we can see in the first annual reports if those investment products are really adhering to the commitments. Again, that's a powerful way to tackle greenwashing, but at the end of the day, you really need investors, also retail investors, who read all those reports, the pre-contractual commitments and then the annual reports, what has really happened in practice, in order to make sure that basically the regulation works. And maybe let me finally just finish by saying that there is obviously a very strong cross-border element there. So we could basically have, I don't know, a retail investor in Romania, to whom investment advice is provided by an Austrian firm. Then the investment product could be manufactured by, I don't know, a German firm, and basically that fund could track a benchmark provided by a Belgian firm. So again, all of these players are regulated by different entities in different countries. So altogether, it's very important, and everybody in this value chain does their job together we can really address greenwashing and ensure that we are contributing to the sustainability transition. So maybe I stop there. I hope it was like conscious enough, and I could give you some overview of or dilemmas, but also the advantages of the progress that we've made with SFDR.
Thank you very much, dear Gábor. One very brief question as I see this nice picture here. What is the reason, I'm asking out of ignorance, what is the reason that financial advisors are not included in the value chain that you present in relation to professional investors? Is there any reason that the legislator chose so, or?
Actually, it's just the legislation. Actually, you cannot put everybody on the chart. So this is a chart from ESMA. I think this is a very good chart. But yeah, I have to also agree that not everybody in the value chain is there. And we could, of course, say that financial advisors are, of course, much more important for retail investors. So basically, that's their job. So that's probably why I would also design this chart here. But in some cases, also, of course, professional investors have a link to financial advisors. But it is more important, obviously, for retail investors.
Okay, thank you very much. Agnieszka, you are the next one.
Thank you so much. So if I, okay, right. You should be able to see my screen now in full. Is that right?
Yes, we do.
Okay, excellent. Thank you very much for confirming. It's a pleasure to be here. Thank you so much for the invitation. Indeed, I've been working with or involved in different types of EBI activities now for 8 years or so. So really excited to be here today to discuss this very timely issue. And as already suggested by previous speakers, what I will focus on is the bank transition planning aspect. So the starting point is really the pledges, right? So we have, especially since the COP in Katowice, but subsequent ones as well, we've seen a rise of pledges from the banks to become net zero. Now, according to BankTrack, one of the organizations that looks at how banks are communicating around their net zero contribution, 63% of banks in the Net Zero Banking Alliance pledged to be net zero in 2050. Following all of these pledges, there was an increased scrutiny as to what it actually means. The risks of greenwashing are evident here. It's easy to make promises, but how do these institutions substantiate what they are doing? So we've seen even more pledges with greater granularity. What a lot of banks are now developing and disclosing are their transition plans, where they provide specific targets in the shorter and longer term as to how they will decarbonize particular portfolios related especially to highly emitting sectors such as oil and gas, power generation, automotive, etc. in this particular case. However, there are a number of problems. So these disclosures, which so far are largely voluntary, they are based on voluntary frameworks such as the Glasgow Financial Alliance. they will subsequently be incorporated in the various frameworks that have already been mentioned that are coming into force, such as CSRD and CSDDD, to which I will return shortly. But first, it's important to identify a number of greenwashing practices that have already been identified, including by the ECB with a very pertinent paper relating to greenwashing practices related to banks' net zero pledges. So some of the problems that have been identified as potentially giving rise to greenwashing are inconsistencies between sectoral approaches. So as I showed on the previous slide, banks would set targets for decarbonization of particular portfolios, but they would, for example, choose only part of the portfolio within a particular sector. They would divide the sectoral division in order to, they would use a sectoral division in order to present better results rather than think through the impact actually. They are, secondly, very often insufficiently ambitious, so they make a lot of assumptions that do not meaningfully contribute to accelerating the transition. They are made, but then there is a subsequent follow-up, and this is indeed something that in the context of uncertainty over the last few years we see a lot of, right? So backtracking, and within the context of these voluntary frameworks, there was no meaningful sanction or for backtracking on any kinds of commitments. The arbitraging is also done around scenarios, and methodologies. So indeed, as Chryssa also mentioned before, the question of scenario choice has been quite a strategic one for a number of institutions in the sense of how they want to present their progress. Banks would then often, because of the net zero component, there have been a use of carbon offsets or carbon credits that clearly do not mean that there is not meaningful engagement with their clients' decarbonization. So there is a general concern about the credibility of these plans. This is just another example. A recent report kind of shows how many of the banks' portfolios looks like when it comes to their fossil fuel versus non-fossil fuel financing. And we see a number of banks here on this list that make very loud pledges as to regard to their net zero commitments. However, when you actually look at their financing activities, the fossil fuels still prevail on the balance sheet. So as a result of this, we've seen a growing interest of microprudential supervisors with this transition planning trend in the banking sector. And we've seen the shift from kind of the voluntary frameworks, which are kind of broader strategy type documents focused on disclosures, towards more mandatory disclosures. This is the regime under CSRD, or kind of corporate governance requirements under CSDDD. But what is the most pertinent for our community also of those interested in microprudential regulation, we've seen prudential supervisors becoming more and more concerned with what these documents mean in terms of banks' risk exposures. And here, the main argument that I would like to leave you with today is that the significance is twofold. On the one hand, bank transition plans can increase exposure of banks to legal risk, operational risk under the most recent CRR definition, as well as reputational risk. So what banks disclose can be a source of risk, but also that these transition plans have been and are increasingly considered a way to more broadly manage identify, manage, and mitigate transition risk across the different aspects of banks' strategies, internal governance, risk to capital processes. When it comes to how the different frameworks sit together, not to overwhelm you with the slide, but the main point is that most of the banking sector will be covered by in Europe will be covered by a combination of disclosure, corporate governance, and prudential requirements that are relevant for transition plans. This makes for quite a complex task for a number of supervisors, especially within the single supervisory mechanism, as a lot of the detail will also depend on how particular jurisdictions will implement the requirements under the corporate reporting directive, which, as was already mentioned, is outward-facing, double materiality, climate change mitigation focused. The CSDDD, which only applies to the largest institutions, and requires an adoption of a transition plan on a best efforts basis, and the CRD, which requires a development of a plan that can encompass all of these other elements, but is more focused on the relationship between the supervisor and the bank, and entails a number of information that will only be made available as part of supervisory reporting rather than outward-facing disclosures. So these different documents, they serve different purposes: corporate governance, prudential, more market discipline versus corporate kind of public duties oriented. They have different time horizons. To some extent, they have different scopes for small, large banks, and they affect banks and other financial institutions in different ways. And this is very important, especially for banking institutions, the credibility of transition plans of which hinges on what their clients will actually be doing. So the implication for this in terms of greenwashing is that while interpreting the different pieces of legislation together can be interpreted as giving rise to an ambitious regime that requires financial institutions to adopt a robust, double materiality-oriented, forward-looking transition planning regime. At the same time, we can expect a number of implementation challenges in the shorter term and possibilities for arbitrage between the different regimes, which could unfortunately give rise to new types of greenwashing practices. This is just to give you a sense that the transition planning regime in the EU for banks from a prudential perspective is anchored in this kind of broader governance change. So the prudential transition planning aspect differs from the disclosure and the rather high-level CSDDD approach in that the prudential transition planning requirement for banks is linked to all of these other elements of the framework, including specific supervisory powers, internal governance requirements, concrete requirements when it comes to risk management, for example, collateral valuation. So in this sense, this internal-facing prudential risk management approach addresses some of the greenwashing concerns. And this is the main point that I wanted to leave you with in the interest of time. So while transition plans can in themselves be a source of legal risk, they can give rise to greenwashing in the way that banks present information related to their strategies, how they substantiate or not their practices. We've already seen this concern whenever we open any of the transition plans of banks that are currently being published. The disclaimers, waivers, dependencies, limitations abound in these documents, and there is already a practice of litigation that is emerging. So as the ING case related specifically to the way in which banks engage with the transition plans of their clients show. So here there was this precisely the concern that was brought by Client Earth, that there is a lack of credibility in how the ING translates its broader strategy into relationships with clients, among other claims. But in addition to this outward-facing disclosure element of transition planning, we also have this approach of transition plans as a risk identification and mitigation tool that is strongly anchored in supervisory processes. And here we can also see an approach that can help address some of the greenwashing concerns to the extent it requires real integration of transition risk management processes in internal governance and how banks deal with their clients and in their forward-looking strategies. And of course, because we are prudentially minded, in how banks assess risks to capital, especially related to credit and market risk. Thank you very much for your attention, and I look forward to the discussion that we will have now.
Thank you very much, dear Agnieszka. I have seen this dictum of Benjamin Franklin that you posted here, as mentioned by Mr. Elderson again and again. Yeah, I remember that Elke König used to refer to it. Yeah, in relation to resolution planning. But this is Benjamin Franklin who initially mentioned that, according to our information. Anyway, there is a lot on the plate, and there is a lot in the chat. I have seen in the chat there was an internal discussion. Yeah, my dear friend Edgar Löw gave also here a very detailed analysis about an aspect that was raised. But I think that we can start with a question here said. It was a statement, a question said by Maria del Carmen Sandoval, who, as a matter of fact, raised the same issue that Agnieszka put on one of her slides. Yeah. And Agnieszka's focus was more on banks' transition plans. Maria puts that in a more general way, the credibility of the disclosures. Yeah. And whether you can rely on them, whether there is cherry picking, and all these aspects that come again and again in the spotlight. I don't know whether you would like to have a response to that general question, Maria, or yourself, Gábor, before we go back to Agnieszka. Maria, Nieto this time, yeah? Maria will answer to Maria.
Okay. My response to that is that there is a lot going on in terms of regulation, okay, at this moment. I compare this with the time of the crisis. Probably, Christos, you remember that. They were, you know, we were going through resolution bail. I mean, there were a lot of regulation because, I mean, there is an issue there. And this is what we are living now. I think we have a paper with Chryssa. And basically, one of our conclusions is that the key of all of this will depend on enforcement. I mean, one aspect that I find positive in this regulatory framework is the long transition periods, because there is a learning by doing here, okay? And it starts with the largest corporates that in principle, they have more means and so on and so forth. Or starts, sorry, with the smaller and then, you know, reaches the largest. So there will be a process of learning by doing. Supervision will be key and enforcement will be key. Without this, definitely we won't have much. We probably will see how this regulation is revised. We have seen it with Basel. We have seen it with everything that had to do with the banking crisis framework. And we will see it with this, even with more of a reason, because this is a completely new field for market regulators and for prudential regulators. So my first reaction to what Carmen, this is the only question that I could see in the chat at the beginning, is that definitely the rules are there. I think that they are well defined, the scope, what should be reported. There will be secondary regulation. We have seen already how the EFRAG this week or the past week already has come, you know, with a proposal for what would be CSRD transition plans. So we will see all of this coming and we will see how it's implemented and we will see what is the enforcement. And probably many of the things that we see now, they will be revised, and rightly so.
Thank you, Gábor.
Yeah, fully agree with Maria. Let me just add another angle. I think we are a little bit talking about lines of defenses, just as with internal controls and the risk management. So I fully agree that, for instance, the supervisory framework or the sanctioning framework is one line of defense. Auditors is one line of defense, and I really like also the discussion that happened in the chat. And let me add just one more line of defense, like the civil society NGOs. So there could be, of course, some, let's say, gaps or inaccuracies, misleading statements that, for instance, even the auditors reveal. But what happens really in practice, what happens in some companies, I don't know, factories with workforce or with environmental, like pollution, all this stuff, very often we are seeing more like NGOs and members of the civil society basically revealing that, shouting out loud, and of course somebody needs to investigate. And again, disclosures are also very well there, so that basically civil societies can hold companies accountable against something which was published, and actually there is a stamp even by auditor, even by a limited assurance stamp, but there is there. And then I would just maybe really would like to highlight that the civil society will also play a very strong role in basically holding firms accountable for their statements and claims.
Thank you. Thank you, Gábor. Agnieszka, I have two related kind of questions for you on the basis of your excellent presentation here. You spoke about the CRD6 and the CRR3, yeah, which are putting a new, you mentioned that, bank-specific framework with regard to this whole discussion. Yeah, banks were already covered by the previous, to a certain extent, yeah, in different ways, by the previous set of regulations. Now we have bank-specific. Now, the first aspect is that the CRR will apply by next year, correct? While the CRD6 will have to be implemented, and this will not be before 2026. In that respect, we have a kind of gradual implementation of these rules into the framework. This is a fact, and I would like to know whether this is something that raises concerns in your view. But on top of that, following your presentation, I came to the idea that eventually the most effective, and it has been mentioned again and again, yeah, the most effective way to overcome the problems that have been identified also in our discussion today with disclosure, with reporting, with disclosures, is to have more strictly enforced disclosure requirements for banks vis-a-vis or any other supervised entity, yeah, insurance companies as well eventually, yeah, vis-a-vis the supervisory authorities. Meaning that in this sense, you go from the pillar 3, yeah, which is mainly in the CRR, to the pillar 1 and the pillar 2 eventually, which makes very much sense because you have the SREP, and then the supervisory authorities have the means to make this more enforceable. My questions those are, first, if you agree with that, and second, if there is any legal risk involved into this.
Excellent. Thank you so much. I guess this is another presentation. I'm sure after my answer, both Gábor and Maria will be also eager to answer. I would just like to make one point to Maria from FBF in the context of this internal and outward-facing transition plan, because I think Maria's question also really points to the core of the problem related to greenwashing, in that because transition plans came out of these voluntary pledges, disclosures, we have some difficulty in understanding what they are and what they are for. And this is definitely not a document that is just about market discipline, right? It does something internally to the internal organization of institutions, whether financial or non-financial. It's used by a number of other stakeholders. I think, Pillar 3 disclosures by banks on climate-related risks are not only read by investors, they are definitely read by a number of stakeholders who are trying to understand also how to influence the financing flows. And that is why a number of, within the supervisory community and analytical kind of scholarly analysis of this trend, there is a differentiation progressing between the notion of outward-facing transition plans and transition planning as a process. So we differentiate between the noun and the verb, and increasingly the focus is shifting from the actual document, which, let's face it, will be read by some AI if we're lucky, and really thinking about how we can meaningfully supervise the internal changes to organization and how environmental and climate change considerations are streamlined and integrated across the within the institutions internally. On this specific questions from Christos, and being mindful of time to make sure that we can answer a number of other issues that were raised. The timing issue is for sure a very pertinent one. Of course, the CRR3, and I will answer these the two questions related to the timing and the kind of shift in prudential perspective together. So CRR3 also includes additional supervisory reporting requirements under 430. So there is already under the regulation, even before transition planning, which is under the directive, comes in, there will already be a more intense supervision of ESG risk as part of Pillar 2. It's already obviously done by a number of institutions within the banking union, but also Hungary, less so in several other member states that are not part of the banking union. So this might be a change more in those jurisdictions, but of course it gives much more teeth to what the ECB has already been doing. And this is the core of the answer to the question about timing. What we've seen with regard to climate and environmental risks within the European Banking Union in particular is ECB adopting a very forward-looking approach, which is very gradual, anticipating future regulatory requirements and allowing the kind of mutual learning to happen between the banking institutions and the supervisors, because the capacity needs to be built both on the private and the public side. So I think if from the perspective of kind of forward compliance and thinking about, it's not just about the date that CRD 6 will be implemented and come into force. There is already a lot of work that is happening within the ECB to facilitate a convergent interpretation of the directive across the different jurisdictions. We will have a revised version of the ECB guide on climate and environmental risks. EBA guidelines on ESG risk management are also coming in Q1 2025. So even before the directive comes live, there will be a lot of convergence in the broader policy regulatory space. Thank you.
And if I may add something to all this soup of letters, I mean, I don't know whether everybody in the audience understands CRR, CRD 6, but the EBA guidelines on transition plans are also coming up, and they will be applicable as of January 26. I think, honestly, I mean, I've been doing, issues regarding to regulation in different phases of my professional life. I see a big difference from the past to what is coming on climate. As I said, the nature of the risk by itself is so different that it will force us to adjust regulation to the facts and not the other way around. And the fact is that this is a forward-looking risk, and It means like we have to, and supervisors and regulators need to understand that they are looking at the future in terms of probabilities, that they are looking at, about how the economy and the policy levers will end up having an impact on the financial system, basically, instead of, being something that imposes certain, common behaviors.
Okay, thank you. Agnieszka, you didn't answer to my question on the legal risks, but still, I will go now to Gábor, asking him, we focus so much on the E of the ESG, correct? There is an S involved and there is a G involved. What about the S? I mean, we see that the social dimension is included in the discussion, but a social taxonomy is not yet there, at least to my understanding, and so intensive as in the case of the environmental taxonomy. Yeah. Would you like to develop on that? It is embedded to a certain extent in other secondary legislation. Yeah. But still, it seems to be the aspect which is less mature, so to say, yeah, than the other two.
Absolutely, and I think this is an important topic because when it comes to the SFDR, let's say, universe, sustainable investments, there are a lot of social investments happening in Europe. This is being reported. We see that. However, there is a lot of flexibility in defining socially sustainable investments, and to put it that way. So SFDR gives us some, let's say, options, like it mentions things like inequality, social cohesion, labor relations, even investment into human capital, which is like a very, very broad concept. So it gives some ideas, but it's not basically a closed-end list. And as you said, we don't have a social taxonomy. We couldn't even say that it's in the pipeline. It will take a lot of time until we get there. And in the meantime, it's very difficult to say if something is really contributing to the social objectives. We know there are some good examples like social bonds, where basically and even principles for these kinds of bonds. And basically, I think there are some very good examples as well. But, well, how can we rule out that, not greenwashing, what social washing is not taking place without basically really having a regulatory framework? Maybe just to link back again, finally, back to the ESRS, ESRD point. Again, I think it helps a lot that basically these social data points and social disclosure requirements are also part of the European Sustainability Reporting Standards. Certainly, it's a very important step in the right direction. And I really hope that there will also be a lot of socially sustainable investments in Europe. But I think we need to a little bit catch up with the green and environmental definitions, which are still not perfect, but absolutely way ahead of defining socially sustainable investments. So I feel there are a lot of need for progress.
Thank you very much.
I wonder whether...
Before coming to the... Go on, Maria. Yeah.
Yeah, no, because I mean, on ESG, I had a question for Gábor. I don't know whether it was a misunderstanding of the presentation, but I think that, I mean, at certain point you say that ESG ratings are not responsible for taking care of greenwashing. But I mean, the question, let me put it, in another way. So is ESG regulation as it is now sufficient to secure that there is no greenwashing, in your view?
No, I think you are setting the bar very high. So I certainly wouldn't say that they are so effective and so powerful. Are you more interested in the ESG rating agency regulation, or because now the EU is of course introducing regulation to regulate ESG rating agencies? So are you interested in basically that aspect?
Yes.
Again, I think like a half full glass certainly helps a lot in my view, that there will be more transparency, more comparability. I mean, the methodologies well, I'm not saying that they are a black box now. This is not true. They are already disclosing a lot of things, but certainly they could disclose more without revealing all of their, let's say, professional secrets. So again, I really think this will help a lot. Basically, also putting them under a regulatory regime. So basically, actually, like regulating them, it's already a big step forward. And I think they will certainly play an important role also when basically there will be much more data out there publicly available because of the disclosures. But again, certainly not a silver bullet that will I think there are no silver bullets in the picture. That's probably one of my takeaways from our discussion, that it's a very complex picture with a lot of puzzle pieces, with bank regulation, ESG rating agency regulation, SFDR, and everybody has a role there, and maybe all together they can be effective, but not single element of that framework can really tackle the greenwashing issue in my view.
Thank you, Gábor. Let me read an answer given by Edgar. That EFRAG has already developed for social standards already, yeah, and the minimum standard is set that will be further developed. Thank you very much, Edgar. This is helpful.
I could add on the social point, because I think it's quite important, and we sometimes forget it in the European context, that, for example, the taxonomy has the minimum safeguards that have already been slowly being integrated into banking practice. A lot of banking sectors across the EU are thinking through what it means for them to comply with the minimum safeguard requirement that requires that any taxonomy aligned activity not only contributes to an environmental objective, doesn't harm the others, but also meets the minimum requirements in relation to labor and social objectives. So at least there we have this seed that can maybe eventually be grow into something bigger also.
But still, we know that 3 years ago there was a kind of a proposal to create a social taxonomy, which has never been completed. Yeah, this is a fact. Now, Agnieszka, on the legal risk, would you like? I will not leave this floor before having an answer on that. Yeah.
No, I mean this was just to. I think what is really important in this transition space is that we think through the implications of introducing a requirement that is just focused on disclosure and preventing greenwashing, because something that we definitely want to avoid also is greenwashing. And somehow with the flurry of the regulatory activity and as kind of strategic litigation around banks multiplies, which of course is a really important tool of enforcement of a lot of this litigation, we have the legal risk is not just that banks will greenwash, but it's also that they will increasingly stop publishing relevant information, which will also make it harder for a number of stakeholders to meaningfully engage and verify, right? So here in the context of the banking sector, it's less of a pertinent issue in the sense that there are these internally oriented requirements of prudential transition plans, right? So which empower the supervisors to engage in a meaningful way if they have the right capacities and prioritization internally also to do so. But it's something that we might want to think about in the context of other financial sectors, other parts of the financial sector especially. Thank you.
Thank you so much. I see here a point. Thank you for your thanks, Aruga, yeah, about their excellent presentations, yeah. One element pending for another session: for all these norms to be fully successful, they need to be part of the strategy for increasing the European power in the world. I will kind of take an element of this to pose my last question to Maria. And this question is the following. If you allow me, I'm a professor of public economic law. That means I follow public policies, yeah? And I'm very much in favor of all this kind of targeted policy interventions in order to preserve public goods. Monetary stability, financial stability, sustainability, investor protection, consumer protection, whatever. Yeah. So we have a set of policy objectives which are putting a burden on the regulators. Yeah. And this burden is a kind of a variable geometry. Yeah. It changes all the time. And this is part of the legal risk as well, Agnieszka, yeah? The legal risk to which part of, yeah, to which the firms are exposed to. Because in an environment of legal uncertainty, yeah, meaning that you have a new set of rules again and again for absolutely legitimate policy objectives, yeah, the question arises to many firms, to many regulators, yeah, and what about our contribution to the financing of the economy, yeah? Our role is there to finance the economy with all these constraints that we are facing, yeah, including on greenwashing, for example, and which is the core of our discussion. We don't know how to schedule about our business plans. We have to modify them again and again. It's extremely costly. This is an aspect which is always in the forefront from the businesses, yeah? And the question is, how can you reconcile the request to achieve all these policy objectives, extremely legitimate, and at the same time achieve what, even if I may say so, in the Draghi report has been highlighted, that the regulatory burden in Europe has become extremely heavy. And if we take into account that in other parts of the world, yeah, I don't need to name them, but very important jurisdictions, you don't have the same level, even of awareness, not to mention of legislation and enforcement. There is a comparative disadvantage for European companies. So what is your answer to that, Maria?
Well, first, thank you for asking that question. You definitely have a point. As I have an economics background, I always say that it's a cost-benefit analysis. Every time the European Commission issues a regulation, there is a cost-benefit associated to that. Now, in the global scheme of things, you're going to say, I mean, for example, global warming is a global objective. I mean, why we need to do more than others? And this is the issue. Okay, just for everybody's peace of mind, this week the Financial Stability Board has published a report on the progress towards globally consistent and comparable climate-related disclosures, for example. And I mean, we have to emphasize that 57% of the global GDP, countries that make up for the 57% of the global GDP, they already have in motion, or they already have regulation on disclosure, for example, for climate issues, okay? 57%. I mean, you would be, for example, surprised that China and Hong Kong, for example, they have a taxonomy very well developed that is interoperable with the European taxonomy. Even the US, that is now, I mean, in everybody's mind at this moment, it has since March, the Securities Exchange Commission has established a standardized climate-related disclosures, and also public companies have to focus on transition plans. So I think this is an issue, this is there, and the question is whether we can use this on our own benefit. I think I said at a certain point in my presentation, and that was my objective, is to send you the sheer size of investment. This is where growth is going to be. I mean, our future growth in Europe will come precisely from that. That's the lever, is how we adjust to these new circumstances. And to the extent that we grab that opportunity, we will have more growth because more investment will flow to that. You as a lawyer and as somebody who does public law particularly, you understand how important it is to define the framework in which all we need to play in this in this field. And this is what we have in Europe. I must admit that we have to check this, and the check is putting this into practice. Much of our presentations today have to do with things that are not fully implemented. We have to be honest with this. And they may not be, for some companies, implemented until 2029. So let's meet again, maybe in a couple of years, and see how things are evolving. But what I can tell you as an economist, our source of growth will come from there. It's the investments that we need to do on sustainability.
With my limited economic knowledge, because I'm a lawyer, but I have studied economics, I would also introduce another element here, which is the implementation lag. Yeah, and this is linked to the transition. Yeah, so growth will come, but eventually with a lag. In the meantime, with all this, my concern is not to introduce rules which are benefiting public goods. And as you correctly mentioned, in this particular case, global public goods. Yeah, we use this term. You have environmental protection and financial stability are global public goods. Yeah, but at the same time, you have an industry which needs to adapt all the time to new requirements. This is my concern. Yeah, and my fear is that we may, at the end, manage to meet all these public goods, yeah, with a more limited pot of companies which might be interested to participate in this exercise. This is the concern, yeah, and it's not only my concern. So the cost-benefit analysis should take that also into consideration. Sometimes, you know that cost-benefit analysis are also constrained by the need to meet policy objectives of priority. Yeah, and this is an inherent, in my view, constraint to the credibility of this cost-benefit analysis. But still, I'm raising something that you know very well, that is raised again and again by the companies. We don't need more rules. By the way, the counter argument is that I remember banks globally were screaming when they were imposed the buffer requirements under Basel III. And when the pandemic broke out and they were allowed to release their buffers, yeah, they were making even advertisements that, you know, we have a lot of buffers to sustain the risks now. Yeah, so it took 10 years, but
Exactly.
Basel III proved to be effective, even in the words of the regulators, which were not so happy with the rules, yeah, with the supervised entities. But still, you have this kind of balance that you need to keep, and I don't know what is the right balance. I'm not saying, I'm asking.
I think you made a point. You are you are somebody who knows firsthand all the framework of banking crisis resolution. How things in Europe would have been different if that crisis resolution framework would have been in place at the time the crisis came up. That could be, you know, for me, the similarity. Now what we are doing is trying to plan to avoid certain outcomes in the future, okay? And this is a welcome, it's very welcome. What is different from what happened in the past is that, in my view, Europe is definitely leading in the world in this respect. While, for example, in crisis resolution, basically, we adopted a framework that the US had adopted. That was, I was working in the US at the time, and I remember that well. And with Basel, something very similar. This time, we are leading. We need people like Agnieszka, like Gábor, like the many more that can join to do good regulation, smart regulation with the minimum cost and the maximum benefit as soon as possible, but definitely making sure that an awful future never happens.
You put a very high burden on Gábor and Agnieszka, by the way, yeah? But still, but you have a point here, a conceptually very solid point, yeah? We tend to say that, in particular in banking, yeah, that regulations are children of crisis. So usually it takes a crisis to adopt rules. So in that respect, you are correctly saying that here you are trying to prevent a crisis. Because, for example, if we had macroprudential regulations before the global financial crisis, we may have avoided that, yeah? So this element of your thinking is fully in line with what I'm also thinking, that it's better to prevent than to try to catch up with disasters. Yeah, that's correct. So thank you very much. I don't know whether there is a final word that you would like to say. Let me start with Agnieszka and go clockwise, Gábor and Maria. Agnieszka?
No, thank you so much. This was an excellent discussion, and I think Inigo's point also around European power and the kind of cross-border extraterritorial aspects of all of this regulation is a topic for another seminar that I think EBI is particularly well placed to address. So I look forward to this.
Yeah, yeah. You will show up again. Yeah. Gábor?
Yeah, fully agree. I think it was also agree that it was a very nice ending to the correspondence, bringing it in this global perspective, the global competitiveness picture. I also see that I think a lot of other countries in other continents like Asia, Africa, even many parts of America are following what Europe is doing. So I think like it's working. Maybe not everybody, not with the same pace, but I think it's happening, and it's very important because altogether we really need a global cooperation in these things. So if EBI organizes another seminar, we could even make it a more global one, and then we could invite other players from Asia, Africa, even America. That will certainly be a very interesting discussion and very useful one.
Yeah. Thank you very much. I keep very good note of that. Yeah, that's a very good idea. Maria.
Yes, to say thank you. Thank you for organizing this seminar. Thank you to all of you who have been attending and you are still here until the end. And let's continue talking about this and take the perspective of time. Thank you.
Thank you all very much. It was, I think, we gave food for thought. Yeah. We had a very good group of attendees. Thank you all for having joined. Many thanks to Ricarda Cal, our angel here. Yeah, she has set up everything. She has prepared everything for us, so it's facilitated, yeah, the work. Thank you again, Ricarda, as always. And let me remind you that on the 25th of November, a Monday, we have the next academic debate on a totally unrelated but still very important issue. Yeah, they are both capital markets law, Agnieszka. Yeah, in that respect, they are related. It is on the uniform prospectus liability rules in Europe, a concrete blueprint. Danny Bush and Matthias Lehmann and their friends, they have invited 3 excellent speakers, colleagues and friends will speak on this topic. Stay tuned. Thank you very much. Wish you all a very nice weekend. And I hope that you have such a nice weather as we have in Athens. We can even go swimming now, yeah? But I fear that this will not be the case in Central Europe, yeah? Okay, thank you. Goodbye. And,
thank you. Bye. Thank you all.
Bye. Thank you.
Bye.
Have a nice weekend.